Listen, most traders lose money not because they can't read charts. They lose because they're staring at the wrong chart at the wrong moment. And if you think that's just a small detail, you're about to discover why that one mistake will cost you more money than any other decision you make in your entire trading career. Here's the brutal truth that nobody wants to hear. The difference between a 15-minute chart and a 1-hour chart isn't technical. It's not about moving averages or RSI or MACD or any of the indicators you've spent the last 3 months learning. It's psychological. And psychology is where 90% of retail traders fail. Not 50%. Not 75%. 90%. That's 9 out of every 10 people who open a brokerage account and decide they're going to trade their way to financial freedom. 9 of them will lose their money. And almost all of them will lose it for the exact same reason we're about to discuss. I want you to imagine 2 traders sitting side by side. Both are professionals. Both have studied the markets. Both have read the books, watched the videos, and spent nights learning technical analysis. And most importantly, both have the same $10,000 account. They're not competing, but they're looking at the exact same stock on the exact same day during the exact same session. They're watching the same market move, the same candles printing, the same volume, the same everything. But one trader has zoomed into a 15-minute time frame. Their screen is filled with rapid candles, quick moves, and lots of action. The other trader is watching the 1-hour chart. Fewer candles, slower pace, less visual stimulation. By the end of that trading day, something remarkable happens. One trader is up $340. They're relaxed. They're thinking about what they'll do with the profit. The other trader has blown through $1,200 of their account and is angry enough to seriously consider quitting trading altogether. They're frustrated. They're second-guessing themselves. They're convinced that either the market is rigged or they're just not cut out for this. So what happened? The difference between a $340 profit and a $1,200 loss trading the same stock in the same session. Was it luck? Absolutely not. Luck doesn't create such a consistent disparity. Was it better indicators? No. They probably used the same tools. Was one trader smarter? Unlikely. They're equally educated on paper. Was one trader just more talented at reading charts? This is where most people get it wrong. The real difference is time frame discipline. That's it. That's the entire gap between the trader who's profitable and the trader who's bleeding money. Here's what actually separates amateurs from professionals. And this is critical, so listen carefully. Amateurs switch time frames when they're losing. They don't do this consciously. But watch what happens in their mind. They've committed to trading a particular stock. They like the setup on the 1-hour chart. They see higher lows forming. They see potential. So they pull the trigger. But then something happens that they didn't expect. The trade goes against them. Maybe it's down 2%. Maybe more. And suddenly their conviction wavers. So what do? They zoom in. They look at the 15-minute chart hoping to find a reason to think the move is temporary. They're looking for confirmation that they should hold. Or worse, they're looking for a reason to exit. And what they always find on that 15-minute chart is noise. Pure noise. False signals. Things that look like rejections and reversals that aren't real at all. So they panic exit. They take a loss. They tell themselves the setup didn't work. But here's the truth. The setup absolutely worked. They just didn't have the discipline to stay with it. Professionals do something completely different. A professional trader commits to their time frame before they trade a single share. They decide in advance whether they're a 15-minute trader, a 1-hour trader, a 4-hour trader, or whatever else, and then they don't deviate. More importantly, they understand something that most traders never figure out in their entire careers. An amateur sees a 1-hour trend they like, and they zoom to 15 minutes to get in early. They think they're being clever. They think they're finding a micro-entry that will give them an advantage. Instead, they get whipsawed by noise. They step in front of a truck that's moving faster than they can see. A professional understands the actual purpose of these different time frames. They know that 15-minute charts show you when to enter a trade. That's their job. They show you the precise moment to step in. But 1-hour charts show you whether you should trade at all. They show you the overall direction, the structure, the thesis. the reason you're taking the risk in the first place. This is the hidden rule that nobody talks about. You won't find it in most trading books. You won't hear it from most YouTube trading gurus because they're too busy trying to sell you a $97 course on indicator settings. But it's the rule that separates the people who make consistent money from the people who are constantly frustrated and constantly losing. The 1-hour chart is a professional's belief system. It's where they develop their thesis about where the market is headed. The 15-minute chart is where they execute that thesis. It's the timing mechanism. It's the when, not the whether. But most traders get this completely backward. They trade the 15-minute chart based on 15-minute logic, ignoring the larger structure entirely. Then they wonder why their win rate is in the 30% range. Today, I'm pulling back the curtain on why most traders fail at time frame selection. Not why they fail at reading candlesticks. Not why they fail at understanding support and resistance. But specifically why they fail when they're trying to decide which chart to look at and when to look at it. And then I'm going to show you the exact protocol the professionals use to stay on one chart long enough to actually make consistent money instead of just spinning their wheels and hemorrhaging account balance. By the end of this video, you'll know which chart to trust in any given moment. You'll understand when to zoom out if you're getting frustrated. You'll know when to stop looking altogether because you're just creating problems for yourself. You'll have a framework that you can apply to any stock, any market condition, and any trading style. But first, you need to understand something fundamental. You need to understand what these two time frames are actually showing you. Not what you think they're showing you. Not what some talking head on the internet told you they show. But what they're genuinely displaying on your screen. And that's where almost everyone gets it wrong. Almost everyone looks at a 15-minute chart and a 1-hour chart and thinks they're just different zoom levels of the same information. That's the foundational mistake that leads to everything else we need to fix. So stay with me, because once you understand what I'm about to show you, you'll never look at a chart the same way again. A 15-minute chart is not a shorter version of a 1-hour chart. This is the mistake that costs amateurs thousands of dollars, sometimes tens of thousands, and occasionally their entire account. Most people think about time frames the way they think about zoom levels on Google Maps. You zoom in closer and you see more detail. You zoom out and you see the bigger picture. But that's not how charts work. That's not what's actually happening when you're looking at price action across different time frames. Here's what's actually happening on your screen when you're staring at a 15-minute candle. You're seeing exactly 15 minutes of price action compressed into a single visual representation. That compressed information looks like a signal to your brain. It looks like data. It looks meaningful. It looks like the market is telling you something specific. But what you're actually seeing is noise, not the signal you're looking for. Noise. Algorithmic noise created by high-frequency trading systems. Institutional order flow turbulence from large players moving money around. Bid-ask spread friction created by the natural mechanics of how orders get filled in the market. When you compress 15 minutes of all that chaos into one candle, your brain interprets it as meaning something. But it doesn't. Not really. Let me give you a concrete example that happens in real markets every single day. It's 10:15 a.m. Eastern Standard Time. You're watching a stock that you've been studying. It's on your watch list. You like the setup. And then something happens. A 15-minute candle prints. It closes near the high of that candle with a long wick extending above it. The wick is prominent. The close is near the top. To an amateur trader, this looks like textbook rejection. This looks like the market is saying no. This is a sign to either short the stock or avoid it entirely. This is a sign that buyers are stepping in but getting rejected by sellers above. So what does the amateur do? They either short the stock, hoping to catch a reversal down, or they stay out of the position they were considering. Either way, they've made a decision based on what they think that candle is telling them. But here's what actually happened during those 15 minutes. An algorithmic trading system, probably running some kind of momentum or scalping strategy, came in and bought 3,000 shares. The price ticked up. The algos scalped their profits and immediately retracted their bids. Price pulled back. The candle printed that long upper wick because of the algo's activity. But then something else happened that the amateur never sees. The real institutional buyers, the big money, came in during the last 90 seconds of that 15-minute window. They started accumulating shares. They started building positions. They're looking at a completely different time frame. They're not looking at 15-minute candles. They're looking at daily charts, weekly charts, maybe even multi-week structures. The 15-minute candle doesn't tell you that story. The noise obscures the signal. The wick makes it look like rejection, when it was actually just the mechanical action of a scalping algorithm. The institutional accumulation that happened in the final moments of that 15-minute period gets completely hidden because it's not yet reflected in a complete hourly candle. It's not yet reflected in a complete daily candle. It's just a few minutes of real buying pressure that got mixed into the noise. Now let's watch what happens when you zoom out and look at the 1-hour chart. That same 15-minute candle that looked like rejection is now just 1/4 of the hourly frame. It's one of 4 candles that make up that hour. And when you see all 4 candles together, the picture completely changes. You're not seeing rejection. You're not seeing a reversal setup. You're seeing a base forming. You're seeing consolidation. You're seeing the market taking a breath before it moves. On the 1-hour chart, that structure is setting up a breakout. That structure is saying that accumulation is happening. That structure is showing you that the institutional money is building a position before the next leg up. A professional trader never saw the 15-minute rejection. They literally wouldn't have looked at the 15-minute candle with any conviction at all. They saw the hourly structure first. They identified the hourly pattern first. They made their thesis decision on the hourly first, and then when they looked at the 15-minute, they looked at it through the lens of that hourly thesis. They weren't asking, does this 15-minute candle look bullish or bearish? They were asking, does this 15-minute action fit into the larger hourly structure I've already identified? This is the critical distinction. This is where the professional's protocol becomes clear. The 1-hour chart is your belief system. It's where you decide whether you think a stock is going up or down or sideways. It's where you build your thesis. It's where you answer the question of whether this trade is even worth your time and your risk capital. The 15-minute chart is your execution system. It's where you time your entry. It's where you answer the question of when to actually put the money down. You do not trade off belief. That's an amateur mistake. You trade off execution. You need a trigger. You need a reason to pull the trigger right now, as opposed to waiting 5 minutes or 5 hours. But, and this is absolutely critical, you do not execute without belief. If you enter a trade on the 15-minute chart without first confirming that the 1-hour chart supports that move, you're trading noise. You're flying blind. You're hoping the market moves in your direction without any structural reason to believe it will. Amateurs reverse this entire hierarchy. They trade 15-minute signals. They see a 15-minute candle that looks bullish or bearish or triggering to their indicator setup, so they take the trade. And then they ignore the 1-hour structure entirely. Or worse, they fight against it. They short a 15-minute candle that looks bearish even though the 1-hour chart is in a clear uptrend. They long a 15-minute candle that looks bullish even though the 1-hour chart just broke below support. Then they wonder why their win rate is 34%. Then they wonder why they keep losing money in setups that look perfect on their time frame. The answer is simple. They're trading the wrong time frame. The 15-minute chart is always noisier than the 1-hour chart. That's not an opinion. That's not a theory. That's a mathematical fact. Shorter time frames contain more volatility relative to their move. Shorter time frames are more influenced by intraday traders and algorithms. Shorter time frames have less institutional conviction backing them. The 15-minute chart always contains more false signals. This isn't a bug in the system. It's not a problem with your charting software. It's not something you can fix with better indicators. It's the nature of shorter time frames. It's how markets work. So the real question becomes this. Are you using that noise to time your entry into a larger move that you've already identified on a longer time frame? Or are you using that noise to contradict the larger move? Are you letting the 15-minute noise override your 1-hour thesis? Because those two approaches will produce completely opposite results. One will make you money. One will lose you money. That answer, the answer to that simple question, will define your entire year of trading. It will define whether you're up or down at the end of this year. It will define whether you make money or lose money. It will define whether you keep trading or you give up and find something else to do with your time. So before you take your next trade, before you look at your next chart, you need to know the answer to that question. There's a moment in every single trade where you must answer one critical question. Which chart do I believe? Not which chart looks the best right now. Not which chart is giving me the most exciting signal. Which chart do I actually believe? It sounds simple when you say it out loud. It sounds like something you should already know the answer to before you even think about clicking, buy or sell. But in practice, in real trading, when real money is on the line and the market is moving and your heart rate is elevated, this decision becomes incredibly difficult. And here's the kicker. This decision, this single moment of clarity or confusion, will cost you money, or make you money, more than any indicator you'll ever study will, more than any oscillator, more than any moving average, more than any chart pattern. This one decision about which time frame you're going to trust is the real driver of your P&L. Let me show you the professional's confirmation rule. It's elegant in its simplicity. It's ruthless in its application. And here's the thing that should concern you. 89% of retail traders have never even heard of this rule. They're out there trading every single day, looking at charts, making decisions, risking their money, and they have no idea that this rule exists. That's why 89% of them lose. The rule is this: never take a 15-minute signal that contradicts a 1-hour signal. That's the entire rule. Write it down. Remember it. Tattoo it on your forehead if you need to. Never take a 15-minute signal that contradicts a 1-hour signal. But the why behind this rule, the reasoning, the deeper understanding of what this rule actually means, will change how you see every single chart you look at for the rest of your trading life. It will fundamentally alter your approach to trading. It will change your results. Here's a scenario that plays out in real markets constantly. You're watching a stock. It's 2:30 p.m. Eastern Time. The afternoon session is in full swing. You've been tracking this stock all day, and when you look at the 1-hour chart, you see something clear. You see a confirmed uptrend, higher lows, higher highs, clean structure. The hourly is your belief. You believe this stock is going up. You believe there's institutional buying happening here. You believe the structure supports a move higher. That's your thesis. That's what you've committed to based on the 1-hour time frame. But then something happens. You glance at the 15-minute chart, just to check, and you see a bearish engulfing candle print. The candle opens higher than the previous close, then sells off hard, closing below the previous close. It looks like rejection. It looks like the buyers came in, got rejected, and are now retreating. To an amateur trader, this looks like a short setup. This looks like an opportunity to make a quick scalp. They think, in and out, catch the pullback, make some quick money. So they short the stock. A professional trader looks at that exact same 15-minute candle and thinks something completely different. That's noise. That's intraday turbulence. The hourly chart hasn't broken. The hourly structure is still intact. I'm not shorting the hourly uptrend based on 15-minute volatility. I'm not going to contradict my thesis because a shorter time frame printed a bearish candle. But here's where it gets really interesting. Here's where most people who think they're professional traders actually mess up too. They see the 1-hour uptrend and they think, okay, I believe in this. So they trade it. They buy the stock. They put money down. They're long. But they make one critical mistake. They don't wait for 15-minute confirmation. They jump into the hourly thesis without waiting for the 15-minute chart to confirm that it's safe to enter right now. So what happens? They buy the stock. The 15-minute chart prints another ugly candle. There's intraday selling pressure. They get shaken out of the position. They hit their stop loss. They take a loss. Then later, the stock does exactly what the 1-hour thesis predicted. It goes higher. It breaks out. But they're not in the trade anymore. They got whipsawed by the 15-minute volatility. Then they blame the market. They say the setup didn't work. They didn't blame their impatience. They didn't blame their lack of confirmation discipline. The real rule is this: use the hourly to identify direction. That's its job. That's what it's good at. Use the 15-minute to confirm entry. That's its job. That's what it's good at. Not to contradict your thesis, not to override your belief, but to confirm that right now, At this exact moment, it's safe to execute based on the direction you've already committed to. In that example, the professional would wait. The 1 hour is up. The thesis is sound. But they won't buy until the 15-minute chart shows at least one bullish candle closing above resistance. That's confirmation. They're waiting for the 15-minute to align with the hourly. They're waiting for the two time frames to agree with each other. That's confirmation. That's the bridge between belief and execution. Once they see that confirmation, once they see the 15-minute candle close above resistance, they know it's safe to pull the trigger. They know the intraday volatility has subsided. They know they're entering at a time when the 15-minute momentum aligns with the hourly direction. This is where most traders get it completely wrong. Amateurs either ignore confirmation entirely, or they demand confirmation from the wrong time frame. They look for 15-minute confirmation of a 15-minute signal. They look for hourly confirmation of an hourly signal. They're asking the same time frame to both create the signal and confirm the signal. That's circular logic. That's not how you use multiple time frames. That's just looking at one time frame and pretending you're being sophisticated. Professionals use both charts as dialogue, not contradiction. Dialogue. The charts are talking to each other. The hourly is saying, this is the direction I believe in. The 15-minute is saying, is it actually safe to enter right now, or is there intraday turbulence I should avoid? If the 15-minute is saying there's turbulence, you wait. If the 15-minute is saying it's clear, you enter. But you never let the 15-minute override the hourly direction. You never let a 15-minute bearish candle make you short an hourly uptrend. You never let a 15-minute bullish candle make you long an hourly downtrend. Here's the maxim that should stick with you. The hourly tells you the what. The 15-minute tells you the when. Never let the when override the what. That's everything. That's the entire philosophy of using multiple time frames correctly. The hourly is telling you what to do. Buy or sell, or wait. The 15-minute is telling you when to do it. Now or later or not at all. But the when never overrides the what. If the hourly is telling you to wait, then it doesn't matter what the 15-minute looks like. You wait. If the hourly is telling you to buy, then you wait for the 15-minute to show you when, but you don't let the 15-minute convince you to sell. Think about how much money this single principle would have saved you if you'd known it before today. How many times have you traded a 15-minute signal that contradicted your longer-term thesis? How many times have you entered a trade without waiting for confirmation? How many times have you let intraday noise override your conviction? This rule eliminates all of that. This rule says be disciplined, know what you believe first, then wait for the smaller time frame to confirm it's time to execute. The question this raises is profound. What happens when traders can't wait for that confirmation? What happens when patience fails? What happens when the conviction from the hourly thesis isn't strong enough to overcome the emotional pull of acting immediately? That's the next piece of the puzzle, because confirmation is only useful if you can actually wait for it. Jesse Livermore kept a journal. Most people who've heard of him know him for his spectacular wins. They know about the times he made fortunes. They know about his catastrophic losses, too. They know about the times he gave back everything and had to rebuild from nothing. Those stories are legendary. They're in books. They're in documentaries. But there's something else he wrote in that journal that almost nobody talks about. There's a pattern in the entries from his best days, the days when his account grew the most, the days when he made the most money. And what he wrote on those days is so simple that most people dismiss it. On the best days of his trading life, when he was at the height of his powers, when he was making real money in the market, Livermore would write just a few words. Today I waited. That's all. No entry, no position, no adrenaline spike, no risk taken, no money deployed, just patience, just the discipline to do nothing. And here's the thing that should blow your mind. On those days when he wrote "Today I waited," his account grew more than on days when he took 10 trades. More than on days when he was constantly active. More than on days when he was moving in and out of positions trying to catch every move. The days when he did nothing were often the most profitable days. This is the part of professional trading that Instagram never shows you. This is the part that doesn't make for exciting content. This is the part that doesn't sell courses or get likes. An amateur trader takes 8 to 12 trades per day, maybe more. They're constantly looking for action, constantly looking for the next setup, constantly looking for the next opportunity. They think that more activity equals more money. They think that the path to wealth is paved with volume. Trade more, win more. That's the logic. But it's backwards. A professional trader might take 1 trade per day, or 0. On some days, they take absolutely 0 trades. They're watching their charts. They're monitoring their watch list. They're being disciplined. They're being patient. But they're not trading. And they're more profitable than the amateur who's grinding out dozens of trades per day. Here's why this works. Every trade you don't take is a trade where you can't lose money. That's obvious. But think deeper. Every trade you don't take is a trade where you can't panic. Every trade you don't take is a trade where fear and greed don't get to operate on your brain. Fear and greed don't show up when you're waiting. They don't show up when you're sitting on the sidelines observing. They show up when you're in a position, when you have money at risk, when the market is moving against you or for you, and your emotions are engaged. When you're waiting, your brain is calm. Your logic is intact. You're thinking clearly. Let me give you a real scenario that plays out constantly in the market. It's Wednesday morning. You've been watching your watch list since the market opened at 9:30 a.m. You're looking at your charts. You're monitoring the stocks you've identified as potential trades, and then at 10:45 a.m., you see something. There's a stock setting up a textbook 15-minute entry into a 1-hour uptrend. Everything lines up. The hourly structure is clean. The 1 hour is in an established uptrend. Higher lows, higher highs. And then the 15-minute chart prints a bullish candle closing above resistance. That's your confirmation. That's your signal to enter. Textbook setup. Exactly what you've been studying. But here's the problem. Here's the reality that most traders never face until it's too late. That stock has already moved 8% from the overnight low. The easy money is already gone. The stock was at $50 this morning. Now it's at $54. The setup you're looking at is happening after the big initial move has already occurred. The move that would have made you the most money is already behind you. Now watch what happens inside the amateur trader's brain. They see the setup. They see its textbook. They see it's technically perfect. But they also see that the stock has already moved. And suddenly there's a voice in their head that says, if I miss this, I'm missing the move. If I don't get in right now, this stock is going to keep going up, and I'm going to watch it from the sidelines making money without me. So they FOMO buy. They fear of missing out buy at the worst part of the candle. They're buying at $54 after it's already moved 8%. They're buying with poor risk reward, but they're buying because they're afraid of missing the move. A professional trader sees that exact same setup and thinks something completely different. This setup will happen again tomorrow, or next week, or in another stock. I don't have to get this one. I don't have to be in every trade. This setup isn't special because it's happening right now. This setup is special because it meets my criteria, and my criteria will be met again, many times, in many different stocks. The professional's capital is deployed only to the highest conviction setups, not the first setup that shows up, not every setup that meets the technical criteria, only the setups where multiple things line up perfectly, where the hourly structure is pristine, where the 15-minute confirmation is crystal clear, where the risk-reward ratio is actually favorable, where they don't have to stretch or convince themselves to take the trade. Here's the formula that changes everything. If you have to convince yourself to take a trade, you shouldn't take it. Read that again. If you have to convince yourself, you shouldn't do it. A setup shouldn't require motivation. It shouldn't require you to talk yourself into it. It shouldn't require you to overcome your own doubts. A real setup, a high-conviction setup, it requires restraint. It requires you to hold back. It requires you to stop yourself from pulling the trigger too early. The setup is so obvious that the hard part is not taking it too soon. This is why amateurs are exhausted. They're grinding. They're trying to make money. They're taking every trade that looks remotely interesting. They're constantly second-guessing, constantly wondering if they should be in more trades, constantly stressed about missing moves. They're emotionally exhausted because they're constantly in the arena, constantly at risk, constantly afraid. Professionals are calm. They're not exhausted. They're not grinding. They're not trying to trade. They're trying to not trade. They're trying to stay out of trades until the conditions are absolutely perfect. They're trying to be disciplined enough to sit on the sidelines and watch good opportunities go by, because they're not good enough. They're trying to be patient enough to wait for the best opportunities. Here's the maxim that ties this all together. Patience is the only position that compounds. Think about that. You're not making money by being active. You're not making money by trading constantly. You're making money by being patient. And every trade you don't take is a fee you don't pay the market. Every time you sit out and watch a trade that you don't take, you're saving yourself from that trade's loss. You're saving yourself from the commission. You're saving yourself from the slippage. You're saving yourself from the stress. But this raises a profound question. How do you know when waiting crosses the line into paralysis? How do you know when waiting for confirmation becomes missing the move? When does patience become fear? When does discipline become hesitation? How do you tell the difference between the professional who's patient and the amateur who's just frozen? That's the question that separates the traders who make money consistently from the traders who are frozen by indecision. And that answer is coming next. Most traders think a stop loss is a number. They think it's a price level. They think it's an exit point. They believe that a stop loss is some kind of technical tool that you set and then forget about. They're wrong. And that misunderstanding is much more dangerous than most people realize. A stop loss is not a number. It's not a price level. It's a temptation. And the size of your position determines how loud that temptation screams at you. The bigger your position, the louder the temptation gets. The smaller your position, the quieter it becomes until it's almost inaudible. This distinction might sound subtle, but it's the difference between traders who survive in the markets and traders who blow up their accounts. Here's a truth that separates the people with $50,000 accounts from the people with $500,000 accounts. The professionals aren't taking bigger risks. They're not being braver. They're not being more aggressive. They're taking smaller positions. That's the secret nobody wants to hear, because it doesn't sound exciting. It doesn't sound like you're building wealth. It sounds conservative. It sounds like you're playing it safe. But that's exactly backwards. That's exactly how professionals actually build wealth. Let me show you how this works in real trading. An amateur trader has a $10,000 account. They've been studying charts. They understand timeframes now. They see what looks like a perfect setup. A clear 1-hour uptrend with a bullish 15-minute confirmation. Everything lines up. They have high conviction. So they size up. They take 500 shares. In their mind, high conviction equals big position. That's the logic. The setup is perfect, so I should go big. I should deploy more capital because I'm confident. The stock moves. But it moves against them. It's just a small move. 3 cents against their position. 3 cents. That's noise. That's normal market volatility. But let's do the math. 3 cents times 500 shares equals $15. $15 in a loss. Now, objectively, $15 is not a large loss. It's not even significant in the context of a $10,000 account. But here's what happens inside the amateur's brain. They feel that $15 loss like it's a $150 loss. The emotional weight is totally disproportionate to the actual dollar amount. The position is so large that even tiny moves feel massive. Even noise feels significant. So what does the amateur do? They panic. They break their own rules. They cancel the stop loss. They tell themselves the stock will bounce. They move their stop down. They're now risking more money to avoid the small loss. They're doubling down. They're hoping. They're praying. All because the position size was too big for them to emotionally handle. Now let's look at that same setup with a professional trader. Same $10,000 account. Same setup. Same 1-hour uptrend. Same 15-minute confirmation. Same everything. But the professional sizes differently. They take 100 shares instead of 500. The stock moves 3 cents against them. That's $3 in losses. $3. That's so small it's almost negligible. It's so small the professional doesn't even feel it emotionally. Their nervous system doesn't register it as a threat. Their amygdala doesn't fire up. Their fight or flight response doesn't activate. They can literally just wait. They can let the structure work. They can do nothing. They can let the 15-minute volatility pass without reacting to it. Same setup, same account, same market move, different position size, completely different brain chemistry. One trader is panicking and breaking their own rules. The other is calm and patient. Here's the mechanism that makes this work. Position size equals emotional noise. That's the equation. The bigger your position, the noisier the market becomes to your nervous system. The smaller your position, the quieter the market becomes. And here's the critical insight. The quieter the market is, the clearer you can think. When your emotional volume is turned down, when the position size is small enough that you can breathe normally, you can actually hear what the chart is telling you. You can think clearly. You can make rational decisions. Thinking is the only real edge you have in trading. Everything else is noise. But most traders size positions so large that thinking becomes impossible. Now here's where this connects back to everything we've been discussing about time frames. Remember what we said about the 15-minute chart? It generates false signals. It's noisy. It's filled with algorithmic trading and intraday turbulence. That noise is always there. But your position size determines whether that noise becomes just background information, or whether it becomes an emotional crisis. If your position is too large, the 15-minute noise amplifies into panic. That panic makes you override your hourly thesis. You exit early. You take a loss. You tell yourself the setup didn't work. But the setup absolutely worked. You didn't work. Your position size was wrong. The professional sizes down into setups that require patience. This sounds completely backward. Shouldn't you size up into your best setups? Shouldn't you put the most money into the trades you're most confident about? No, the opposite. The professional sizes down into the setups that require the most patience because sizing down gives them permission to wait. By reducing their position size, they reduce the emotional volume. They make it physically and psychologically possible to hold through the 15-minute noise without breaking their own rules. Think about this from a practical perspective. If you have a setup that you're highly confident about, a setup where you're willing to wait for the hourly structure to play out, then you need to size in a way that makes waiting possible. You need to size so small that the 15-minute turbulence is background noise instead of a crisis. You need to size so small that when the stock moves 3 cents against you, your nervous system barely registers it. That's how you actually wait. That's how patience becomes possible. Here's the maxim that captures this. Your position size is your honesty meter. If you can't sleep with this position, if you can't sit calmly while your computer is closed, if you wake up in the middle of the night thinking about the trade, then you've sized too big. Your position size should be small enough that you can forget about it. Small enough that you can go about your day. Small enough that the market noise is genuinely background information instead of an emergency. This is what separates people who are stressed and burned out from trading versus people who are calm and consistent. The calm people sized correctly. The stressed people sized too big. It's that simple. It's that fundamental. Here's what happens next. Once you really understand position sizing, once you've committed to your time frames, once you're actually waiting for proper confirmation from the 15-minute chart, something shifts in how you relate to the market. You stop trying to trade. You stop trying to force outcomes. You stop trying to make money. Instead, you start observing the market. You start letting the market come to you. You start letting the structure reveal itself instead of trying to impose your will on it. You're not fighting the market anymore. You're dancing with it. You're letting it move while you stay calm and positioned. That shift in perspective, that shift from trying to trading to observing, that's when the real money starts. That's when your account actually begins to grow consistently. Because now you have all the pieces. You have the time frame discipline. You have the confirmation rule. You have the patience to wait. You have the position sizing that makes all of it possible. Let me bring all of this together. Let me connect every piece we've discussed so that you can see how this works as a unified system instead of isolated rules that don't seem to fit together. You now understand that the 1-hour chart is your belief system. That's where you form your thesis. That's where you decide whether you think a stock is going up or down, or sideways. You understand that the 15-minute chart is your execution system. That's where you time your entry. That's where you find the precise moment to put money down. You understand that confirmation is not contradiction. You understand that you never take a 15-minute signal that goes against your hourly thesis. You understand that waiting and small position sizing are what actually make waiting possible. You understand that patience compounds, and that every trade you don't take is a fee you don't pay the market. But there's one final piece, and this is the piece that separates traders who are aware of these rules from traders who actually profit from them. This is the piece that transforms understanding into results. It's called the pivotal point. The pivotal point is the exact moment where you stop looking at the 15-minute chart and commit fully to the hourly thesis. It's the moment of entry. It's the moment where your confirmation is complete and you execute. But more importantly, it's the moment where everything changes about how you manage the trade. This is where professionals make their money. This is where amateurs blow their accounts. This is where the discipline you've built either holds or collapses. Here's how it actually works in practice. You've been watching a stock for days, maybe even a week. The 1-hour chart has shown you something clear. You see a clear uptrend, higher lows, higher highs, clean structure. You believe in this direction. You've formed your thesis. The hourly chart is your belief system, and it's saying, yes, this stock is going higher. But the stock hasn't moved yet. There's no confirmation. The 15-minute chart hasn't aligned with the hourly yet. So you wait. You're patient. You're watching. You're observing. You're not trading. You're just waiting for the moment when the two time frames align. Then one day, something happens. It's 11:23 a.m. Eastern Time. You're checking your charts like you do multiple times throughout the day. And you see it. The 15-minute chart breaks above a previous 15-minute high. That's your confirmation. That candle closes above resistance. That's it. That's the moment. That's your pivotal point. The moment you see that candle close above resistance, something shifts in your brain. You stop asking, should I trade this? You already know the answer is yes. Your hourly thesis is confirmed. The two time frames have aligned. The setup is complete. Now this is absolutely critical. This is where most traders fail, and this is where professionals succeed. The moment you enter the trade, the moment you have confirmation and you've sized in, you stop looking at the 15-minute chart. Not forever, but for the duration of this trade, you stop managing on the 15-minute. You shift to managing on the hourly. You set your stop loss based on hourly structure. You might place your stop below the hourly low. You let the position work. You don't get shaken out by 15-minute turbulence. You don't panic sell because a 15-minute candle looked ugly, because you've already paid for your confirmation. The 15-minute did its job. It showed you when. Now the hourly is going to show you the move. This is where 80% of traders fail. They get confirmation on the 15-minute. They see the setup. They pull the trigger. They enter the trade. And then they immediately make a terrible mistake. They return to staring at the 15-minute chart. They keep the 15-minute chart in the center of their attention. So what happens? The market does what it always does. A 15-minute pullback occurs. A 15-minute candle prints that looks bearish or weak. And suddenly, the trader is scared. They forgot why they entered. They forgot about the hourly thesis. They only see the 15-minute pullback. So they exit. They cut the position. They hit stop. They take a loss. And then later, the stock does exactly what the hourly structure predicted. It breaks out. It moves higher. It goes on a run. But they're not in the trade anymore. They exited during the 15-minute noise and missed the real move. Then they blame the setup. They say it didn't work. They say the technical analysis failed them. But the setup absolutely worked. The trade worked perfectly. The hourly structure was right. The 15-minute confirmation was correct. The problem wasn't the setup. The problem was them. They didn't work. They couldn't hold through the 15-minute volatility because they kept watching it. They kept staring at the wrong time frame. A professional trader enters the trade differently. They get their confirmation. They size in appropriately. They enter the position. And then they deliberately stop monitoring the 15-minute chart. They literally close that window or push it off to the side. They look at the 1-hour chart instead. That's where they're managing the trade now. But even with the hourly chart, they don't stare at it obsessively. They come back at specific time-based checkpoints. They come back at the close of the next hourly candle. That's when they reevaluate. Not mid-candle. Not based on a 15-minute wobble. Not based on 3 cents of movement. They come back when a full hourly candle has completed and they can assess whether the structure is still intact. If the hourly structure is still intact, they hold. If the hourly structure has broken, then they exit. But that decision is made on hourly data, not intraday noise. This checkpoint method is what allows professionals to actually sit through trades. They're not fighting the urge to check every minute. They're not exposed to constant micro moves. They have defined moments when they check and reevaluate. The rest of the time they can go about their day. They can do other things. They can be calm. Here's the maxim that captures this entire concept. The 15-minute gets you in. The hourly keeps you in. The 15-minute chart is your entry tool. It confirms that it's safe to enter right now. But the hourly chart is what keeps you in the trade during the inevitable pullbacks and volatility. The hourly is what gives you the conviction to hold through the noise. Now here's the recursive truth that's hidden inside all of this. Here's what most traders never realize. The reason most traders fail at time frame discipline isn't because they don't understand charts. It's not because they lack knowledge. It's not because they haven't studied enough. It's because they're not managing their own psychology. You size too big because you're greedy. You want to make as much money as possible, so you put too much capital at risk. You switch time frames because you're scared. When the trade goes against you, fear kicks in and you start looking for reasons to exit. You ignore confirmation because you're impatient. You want to get in right now, instead of waiting for the setup to fully develop. You watch the 15-minute chart after entry because you don't trust the process. You don't really believe in the hourly structures, so you keep checking the short-term chart looking for evidence that you should get out. All of these failures come back to psychology. They come back to whether you trust the system you've built. And trust is earned by following the process. Trust is not given. Trust is earned through repetition. The process is this. Identify your hourly thesis. Wait for 15-minute confirmation. Size appropriately. Enter the trade. Shift to hourly management. Reevaluate at hourly closes. That's the process. That's the complete system. By the time you've executed this process 15 times, something changes. You'll trust it. You'll have enough data points to know that it works. You'll stop second-guessing yourself. You'll stop wondering if you should be doing something different. Your account will stop shrinking because you'll stop making emotional mistakes. Instead, your account will start growing. It might not grow explosively. It might not grow in a way that looks impressive. But it will grow consistently. Month after month. Trade after trade. That consistency, that boring, predictable growth, that's when you become a professional. Being a professional trader doesn't mean being the smartest. It doesn't mean having the best indicators or the most sophisticated analysis. It means having the discipline to follow a process even when it's boring. It means having the patience to wait for confirmation. It means having the position sizing discipline to stay calm. It means having the psychology to manage your emotions instead of letting them manage you. It means understanding that time frame selection isn't technical, it's psychological. And mastering your psychology is what separates the winners from the losers. You now have the entire framework. You understand the belief system versus the execution system. You understand confirmation. You understand patience. You understand position sizing. You understand the pivotal point. You understand how to manage a trade once you're in it. The question now is whether you'll actually apply this, whether you'll actually follow the process, whether you'll actually give yourself the gift of becoming professional.